Let's bring in our trillion-dollar power panel, Nuveen chief equity strategist Bob Doll, with $1.1 trillion in under management at as far as the end of last year. We know that's probably a moving target now, but we're also joined by U.S. Bank Wealth Management Chief Investment Officer Eric Freedman. To you, Bob Doll, are you seeing any entry points at all that you like at the moment?
Well, I'm still enamored with healthcare. I still think the AbbVie and the Gilead names that are part of where we'll still have demand for product and hopefully some solutions. We still think the HMOs, you take your favorite, United, Cigna, Humana, are probably still good places to be relative to the market. But we've got to calm down the treasury market and, more importantly, the credit markets before we can have a sustainable rally in equities.
Eric, let's get to all that's happening when it comes to the financial pipes. There have been all kinds of announcements from the government saying we're going to put money here, we're going to add money there. The Federal Reserve has really stepped up and is working the Xerox machine on the printing of the money pretty much overtime. I think there's smoke coming out of some of those printers. But talk to me about whether it is working. Are you seeing any cracks, or are you seeing encouraging signs right now? Eric. Did we lose Eric? All right. For the moment, I believe, Eric, do you have us?
Let me just. Me, correct?
Yeah, go ahead, Eric.
Okay, Liz, sorry about that.
No worries.
So we have seen certainly a significant response by the Federal Reserve, and really step one of this process is to make sure the market is functioning, not just the equity market, and you made several good points earlier about what's happening at the New York Stock Exchange, but also just the free flow of credit across municipalities, across different parts of the commercial paper market. So really the first step is to make sure we are seeing liquidity happen. And right now that transmission mechanism is okay, but it needs to get better. The second part, of course, that we have to see in earnest is the fiscal response. And so the longer it takes for Washington to have a more defined program and a very tangible one, the more markets are going to wait. And again, patience levels are quite low right now. So those are really the two things we have to see: is one, ongoing functioning of financial markets and financial transactions, and then secondly, more clarity on fiscal.
Yeah. Bob, I've been looking at some of the economic data for next week, and the team and I here at Claim & Countdown had looked at the fact that we're going to get some manufacturing data next week that will, I guess, encompass some of this very bad news we've gotten in the last couple of weeks. We're talking about the Institute for Supply Management. Lets us know the health of the manufacturing sector, the PMI. Could this force the markets, if it is a particularly ugly number, could it force the markets down even more? And would those be the days that you would advise people to maybe scoop up some of the names they've really been waiting to buy?
It certainly could, Liz, that is, be worse than expected, but the expectations have dropped significantly. Even within the last 48 hours, economists are falling all over themselves, seeing who can have the lowest number for the second quarter GDP, for example. So I think the market's expecting a really horrible number, a horrible set of numbers. And I come back to what Eric just said. More important than the fundamentals now is, can we get the system back on track? Liquidity, credit spreads, and can we get Washington to sign something sooner rather than later? Let's hope the Republicans and Democrats don't sit and fight about the details, but get this bill moving to restore some confidence and reduce the fear. That's the most important part.
Eric, give me your thought. Why are we losing confidence in these final 5 minutes?
Biggest thing, Liz, is just there's a lot of technical selling happening as a function of this quadruple which I won't waste viewers' time on. But this is certainly a liquidity-driven event that doesn't happen every week, so that's a positive. The biggest thing happening right now, and you touched on it, is the knock-on effect of energy in the credit market. So we really need to have some stability within energy and energy prices. Of course, a lot of credit is tied to energy. These aren't new news. This isn't things we haven't heard before. But again, we need to make sure we have stability there first before we can form a better base.
We had warned, Bob, our viewers, and I put it out on Twitter, that quadruple witching, which is the expiration of all kinds of futures and options for both market indexes and, of course, individual stocks, would cause volatility. That's what we're seeing. You got 10 seconds to tell us what you hope happens on Monday.
We hope it's up on Monday. There's no question this quadruple was a negative, along with the credit spreads, along with forced selling by hedge funds and risk parity products.
All right, we want to thank Bob and Eric. The Dow closes out its worst week since October of 2008, and there you see a single person ringing the bell on the floor of the New York Stock Exchange that will now close for the next couple of weeks.